let's get started. We are still, Michelle, I'm seeing your emails. We are working on the captions as we speak. Welcome everyone to NCVC's second webinar for the crime victims community in COVID-19. Just a reminder, we push out a lot of information through our Facebook group, which can be found on Facebook by searching Crime Victims Community in COVID-19. We will also be pushing out the results of our survey and the other polls that we've been running on that page if you have any interest in that. Our next webinar is going to be in 2 weeks, where we will be focusing on domestic violence and child abuse, and we will be announcing that date soon. Today's webinar topic is on the CARES Act. I know it's causing a lot of confusion, both personally and professionally, for so many people. So we've put an expert panel to walk you through this, and we're going to take pretty much the whole time today if we need to make sure that we get through your questions. So just as a reminder for Zoom, if you hover on the bottom, you'll see a Q&A. You can ask any questions in there. We're going to leave the chat open for anybody to chat with each other, but we won't be taking questions from the chat. We'll be taking questions from that Q&A, which we can monitor. Feel free to ask any questions of our panel. We're going to take the whole time to let them talk to work through this. But we will be holding most of the questions until the very end, and then we'll be asking the panel. Okay, so with that, today we have some very special guests with us. We have Andre Buradi from Blueprint Financial. We have Mona Noonley from Puzzle HR and Michael Burns from Health Wealth Advocates. So I am going to turn it on with over to Mona.
Thank you very much, Renee. All right, so are you going to do these? Am I doing the screen share now?
Yes, you can share your screen now.
Okay, just making sure you can see. Is this what you're seeing, Andre?
Yes.
Okay,
perfect.
Fabulous. All righty, thank you and welcome everyone. Happy Friday. This webinar is about dealing with the HR and the financial implications of the COVID-19 crisis, specifically the CARES Act and the provisions applicable to the nonprofit community. And our intention is to keep you as up to date as we possibly can, because we're all going through this together and we want to do our part to help whoever we can weather the storm and come out the other side stronger than when we went in. As Renee stated, my name is Mona Noonley, and I am the Mid-Atlantic Regional Manager at Puzzle HR. We're an outsourcing company that spans across the United States. And I've had about 25 years of HR resources consulting experience with small to medium-sized businesses in the greater Washington, D.C. area. My counterparts, Michael and Andre, will be introducing themselves as well during this presentation, so you'll get to hear a little bit more about them. But moving forward, this seminar is really a result of our multidisciplinary collaboration with my co-presenters, Michael and Andre, because the CARES Act has so many moving parts, and it includes not just the finance, but it impacts us individually, it impacts our company, and it impacts our family. So that said, I would like to read this disclaimer to you before we can dive into the presentation. Please note that the course material and content are for informational purposes only and do not constitute legal advice. Nothing herein or in the course materials shall be construed as professional advice as to any particular situation or constitute a legal opinion with respect to compliance with any federal, state, or local laws. Participants should not act upon this information without seeking professional counsel. This information is not provided in the case of an attorney-client relationship and is not intended to constitute legal advice or to substitute for obtaining legal advice from an attorney based in your state. All right, so there's been so much content released since March 18th, and naturally there are questions from employers and employees. The CARES Act has gone through some revisions since it was signed into law, and there's been more clarity on some of those provisions. Information continues to come at us at breakneck speed and continues to change daily and at sometimes hour by hour. We took the frequently asked questions and addressed them today in this presentation. Hopefully we'll get to your questions. If not, then we'll be able to address them to you, address them with you directly. So let's get started with our agenda. We will be taking a look at the Family First Coronavirus Response Act, the Paychecks Protection Program, the Coronavirus Aid, Relief, and Economic Securities Act, which is known as the CARES Act. And within the CARES Act, there will be a component to the health and retirement benefits that affects all of us. I'll be speaking with you for the first half hour, so please be kind if my voice cracks or if I fall out of my chair. Okay, we'll do a quick recap. The Family First Coronavirus Act, also known as the Family First Coronavirus Response Act, also known as the FFCRA, was signed by President Trump on March 18th, 2020, and it went into effect on April 1st, 2020, and expiring on December 31st at the end of this year. The intent of this act is to provide 2 payroll tax credits to small businesses and organizations. It's designed to immediately and fully reimburse them, dollar by dollar, for the cost of providing coronavirus-related leave to their employees. It allows American businesses with less than 500 employees the funds to provide employees with paid leave. And the leave is either for the employee's own health needs or the need to care for a family member. The legislation will enable employers to keep their workers on their payroll, while at the same time ensuring that workers are not forced to choose between their paychecks and the public health measures needed to combat this virus. So part 1 of the FFCRA is the emergency FMLA. First to note that this is an expansion of the existing Family Medical Leave Act, which was originally enacted in 1993 and signed into law by President Clinton. However, a key difference is that prior to COVID-19, the FMLA law was a job protection law with no compensation elements and was applied to businesses with more than just 50 employees. Now with this legislation, it's any business with fewer than 500 employees, and it has a compensation built in it. There's been guidance from the Department of Labor on how to calculate the 500 employees threshold for this EFMLA. So if you need that information, please let us know and we'll get that to you directly. For today's purposes, I think that we're dealing with mostly smaller organizations. So the employee has to be employed at least 30 calendar days, and it covers up to 12 weeks of job protection for them to apply for this. So who does it cover? Well, it covers those employees unable to work or to telework because they have to care for a child because that child's school or place of childcare has been closed, or the childcare provider is unavailable due to a public safety emergency declared by the federal, state, or local authority, as in this case with COVID-19. Now, note that this does not apply to employees laid off due to the lack of work or closed businesses. You can consider this as a childcare FMLA component specific to COVID-19. What's new from the DOL since its first release is that any prior FMLA use could reduce the availability of the emergency FMLA and vice versa. So EFMLA can reduce availability of FMLA later in the plan year. This may be revisited because things are, again, as I say, fluid and continuing to change. So who would this affect? It would affect pregnancies, other health issues, caring for a family member not related to COVID-19, because those things still happen, right? While COVID-19 is taking over our consciousness. So again, stay tuned. Let's get to the compensation part. How much can employees receive? Well, there's no pay for the first 10 days of leave, but they could take other paid time off and emergency sick leave under the FFCRA could be applied to this. After 10 days, employers must pay 2/3 of the employee's regular rate of pay for the number of hours worked for the number of hours they would be working if they were scheduled. And it's capped at $200 a day, and $10,000 in the 12-week period. Again, this is the emergency family medical leave expansion. As with FMLA, there are some requirements for reinstatement. The same reinstatement provisions apply as applied under the traditional FMLA. However, restoration to the position does not apply to employers with fewer than 25 employees if certain conditions are met. The conditions are as follows. If the job no longer exists because of the changes affecting employment caused by economic downturn or other operating conditions that affect employment caused by a public health crisis and emergency. The second would be the employer makes reasonable efforts to return the employee to the equivalent position and makes the effort to contact a displaced employee if anything comes up within a year of when they would have returned to work. This is the new part. EFMLA can be taken intermittently, only when it's related to school or childcare closure and the employer allows it. Note, the employer allows it. So what that means is that a family with two parents can use EFMLA intermittently, 1 week on, 1 week off, but that permission is granted by the employer, and it's a conversation between the employer and the employee. That's what is new. Okay, so part 2 of the FFCRA is the emergency paid sick leave. So who does it cover and what are the details of this sick leave? It covers employers with fewer than 500 employees, and which is different criteria than the EFMLA. And it starts day 1, so there's no waiting period for the employees to be eligible. So calculating the 500 employee is the same as the EFMLA doing the count, and this means that it starts the day the employees the employee's leave would start. But the EPSL uses a different calculation than the EFMLA. The EPSLA uses the joint employer test, and I don't know if this applies to anyone on our webinar today, but if you have a complicated ownership or co-employment in your organization, please let us know and we'll send you the information on how to figure out the 500 employee count. So it's important to note that a stay-at-home order does not justify a paid sick leave. All right, so what is covered and what is the paid leave? The purposes of the leave covers things when, number 1, there's an issued quarantine or isolation subject to federal, state, or local quarantine. You get paid at 100% of your wages. 2, when advised by a healthcare provider to self-quarantine due to certain related issues of the COVID-19, you still get paid at 100% of your regular pay. Number 3, when experiencing symptoms of COVID-19 and seeking a medical diagnosis, you'll be paid at 100% of your pay. So this is where it's going to shift a little bit for number 4, 5, and 6. When you're caring for an individual going through number 1 or 2, see the above, then you would get 2/3 your pay. And when caring for a child whose school or place of care is closed due to COVID-19, you'll get 2/3 of your pay. And or finally, when the employee is experiencing any other substantially similar conditions to COVID-19, you would get paid 2/3 of your pay. Okay, this paid leave is capped at $511 a day and $5,110 for reasons number 1, 2, and 3 here. The pay cap is at $200 a day and $2,000 for the reasons 4, 5, and 6 when it's caring for someone else. Now, an employee who's unable to work due to care for a child whose school is closed or a child care provider is unavailable may, in some instances, receive up to an additional 10 weeks of expanded paid family and medical leave at the rate of 2/3 the employee's pay. And that goes back to element 1 here, which we've already reviewed, and the job protection on the EFMLA. So the combined total paid would be $12,000 if that was the situation. All right, so how did this new paid leave interact with other employer-provided sick paid leave and other paid leave already in existence? The Act does not preempt any existing state and local paid leave, and employers cannot require employees to use other leave first. So sick leave provided under the Act does not carry over and does expire on December 31st of 2020. There are some healthcare benefits mandates in this as well. I'll cover the part to let you know that the Act requires all insured and self-funded medical plans to cover diagnostic testing related services for COVID-19 at 100% without any deductibles or copays. Now, this is for testing, not treatment. And Michael Burns will be going a little bit further into this because that's his area of expertise. Getting back to the payroll tax credit, which went into effect on April 1st, is the immediate advantage for small businesses to, it's the payroll tax credit is to take immediate advantage starting April 1st of the paid leave credit. So businesses can retain, funds that they would otherwise pay to the IRS in payroll taxes to cover the cost of wages and employer provided health care. If those amounts are not sufficient to cover the cost of paid leave, the employers can seek an expedited refund from the IRS. All right. It's important to note that not all businesses can do this, right? Because this can be an economic strain to the business. There is a way that businesses can self-exempt. There are some criteria, and the FFCRA states that the Secretary of Labor has the authority to exempt small businesses with fewer than 50 employees if the business viability is jeopardized by following the FFCRA. That makes sense, right? If it's going to put your business out of business, the Secretary of Labor can exempt that. And the Department of Labor published last week that small businesses may exempt themselves due to school, childcare closure only if certain criteria are met. And what are those criteria? Well, it would pretty much have to financially cripple the company by following or allowing. It would severely limit operational capabilities due to a loss of specific skilled labor or a labor shortage. That's a lot of words, and I'll explain that later. Okay, so what you're looking at right now, this is the required notice that must be posted or emailed to your remote employees. You can get this form from the Department of Labor website or your payroll provider or your HR support or outsourcing company. And I'd like to dive into the Coronavirus Aid and Economic Securities Act, which was signed into law on March 27th by President Trump. Okay, so known as the CARES Act, we'll cover the provisions that are relevant to nonprofit organizations and to donors and small businesses. This is phase 3 of the stimulus packages signed into law within the last 4 weeks now. This $2.3 trillion stimulus package has significant impact on nearly all aspects of our economy, from small to big corporations and individuals. For today, we'll focus on the individual and the businesses with less than 500 employees. All right. We're going to first hit up the allocation detail to the individual, because this is a big one since it affects Americans, and we can get financial relief via one of two ways: through the boost in unemployment, through the checks that the feds are issuing, and through a reduced individual tax. We'll cover the unemployment benefits first. So the unemployment boost is through July 31st of 2020, and it covers workers not normally covered by state unemployment, such as independent contractors and gig workers. Gig work is usually on call, it's freelance, it's contract work, but it's not clearly defined, so expect more to come on this one. So the boost in the state unemployment benefits is significant, right? So state unemployment is run by the state, and each state has their own rules and how much they pay. However, through this, the federal government will be giving $600 per week additional, and it is run through the state. Also, an additional 13 weeks of benefit beyond the state provided benefit. Many of the states are either 26 weeks of benefit and some are less, but here you can get up an additional 13 weeks of benefits. So if your state has 26 weeks of benefit, add another 13 and you get a total of 39 weeks of benefit. Now note that there are some strings attached to these provisions for the states to get the Fed support. First, they need to eliminate the wait period, which most have already done, if not all. And the paid leave doesn't qualify for unemployment, but a furlough does. So to clarify, a furlough is usually a government term, which means that employees are not paid their full wages because of whatever economic things is going on, but the intent of the employer is to bring them back at the full rate. That's a furlough. So there's been some issues with this plan because some people will make more with the additional $600 than if they work. So it might be hard to bring some of them back when they're needed. And some changes may come to this as well. All right, so the one-time issue checks. This, some of us have been getting and others will be getting in the coming days and weeks. The payments will be coming by direct deposit if you got a refund to that account in the last 2 years. If not, then they will send you the check to your last known address. You'll be notified that the check is coming and you have 15 days to correct the address if it's not the correct one. The check is based on earnings filed on your personal 1040 using 2019 information if it's already been filed. If not, then they'll be using the 2018 information. So if you haven't filed because you're on Social Security or didn't earn enough, you'll still get a check. Anyone with a Social Security number is eligible, including disabled veterans and people who are here on work visas too. The question is, how much? Per adult will receive $1,200, $500 per child, $2,400 for couples filing jointly. Individual filers must make less than $75,000, and couples must earn less than $150,000 total. The head of the household filers must make less than $112,500, and for every $100 that you earn over the limits, your payment will be reduced by $5. So if you made $80,000 in 2018 or 2019, you'll receive a check for $950. It decreased incrementally down to zero for individuals making more than $99,000 and joint filers making more than $198,000. The tax reductions to the individuals can be adjusted in their HSA accounts and in a few other places, and we'll talk about that when we get to the health insurance. It's also loosened the restrictions on charitable contributions. There are some changes to the retirement and the pension distributions, and Andre will be addressing that. So it's important to note that the CARES Act prohibits foreclosure of federally backed mortgage loans on residential real estate property with 1 to 4 units for 60 days beginning March 18th of this year. Additionally, borrowers may request for forbearance based on financial hardship during the the COVID-19 emergency for up to 2 periods of 180 days. The Act also prohibits eviction filings for 120 days against residents of property that has a federally backed mortgage loan or that participates in certain covered housing programs. All right, so this is really where a lot of questions come up, and most people hear different things, and I want to bring to you what we know as it exists today. It's the allocation to the small businesses. It's a tax credit for delaying payroll taxes. Know that neither of these can be taken advantage of if the business is getting one of the SBA loans under the CARES Act, and we're going to cover that soon. So tax credits. And any employer, regardless of size, is eligible for the credit during the calendar year of 2020 for qualified wages that were earned from March 13th through December 31st of this year, if the business is, number one, fully or partially suspended due to a governmental order related to the COVID-19, or secondly, the company experiences a significant decline in gross receipts, for example, a reduction of 50% of gross receipts from the same quarter in 2019 during that period. For eligible employers with 100 or fewer full-time employees, the credit applies to all employee wages. However, limitations apply for employers with greater than 100 full-time employees. If that's you and you want to know more, please let me know and we can address it. The qualified wages are capped at $10,000 per employee. So the credit is equal to 50% of the qualified wages paid by the employer with respect to each employee, up to $5,000 per employee for all of 2020. And just some quick math on that. So if you're an employer with 10 employees and they make, and your taxes on them is $20,000, well, you would only get taxes up to you would only get credit for $10,000 of it, with the stipulation that it's up to $5,000 per credit per employee for all of 2020. The credit's available to all corporations as well as LLCs, S corporations, partnerships, sole proprietors, and to most tax-exempt organizations. The tax could be claimed against the employer portion of employment taxes. Again, if the credit exceeds the tax, the credit is treated as an overpayment and is refundable to the employer. A credit does not have to be paid back as long as the employer meets the requirement for the credit. If the business claims the FFCRA credit for mandatory leave and for FMLA leave, then the wages associated with the FFCRA credits are not eligible as qualified wages for the employee retention credit. There's no double dipping, either one or the other. Okay. The CARES Act will also allow employers and self-employed individuals to defer paying their portion of the Social Security tax, which is 6.2%, for wages accrued between March 27th and December 31st of this year. The deferred amounts will ultimately have to be paid in 2 installments. Half will be due on December 31st of 2021, with the remaining half due December 31st of 2022. All right. So this is the Paychex Protection Program. And there's really no difference between what the for-profit and the nonprofit can receive. The last few weeks, there have been a whirlwind of, again, legislative changes. It's like, 1 week of coronavirus time is equal to more than a year of pre-coronavirus time in terms of the legislations that's been coming at us. As a matter of fact, yesterday there were more clarification to the CARES Act, and I would imagine that's going to continue to evolve as we have more time to digest this and questions to what the provisions really mean. So as things change, the decisions you make as an employer could also change. And knowing these changes have to be job number one. Job number two is understanding and relating it to your specific situation. So there are a couple of loans available to small organizations out there. There is the Economic Injury and Disaster Loan, the EIDL loan, and the Paycheck Protection Program, what we call PPP. The Fed has set aside $349 billion in forgivable loans to small businesses to pay their employees during this crisis. And the PPP loan went into effect on April 1st. But what we've seen is that banks weren't ready to accept applications until April 3rd. And there's been a lot of confusion around this. The provision's been causing quite a bit of buzz and generating a lot of questions. So we're going to address some of the commonly asked questions. The what, the when, where, and how much, and where can I apply, and who can apply, and what are the eligible expenses. So we're going to take some time going through this right now. The what, where, when, and how much. Okay, so in this section, the federal government is waiving the usual SBA requirements that you typically have to obtain some or all the loans funds from other sources. For example, they're waiving the credit elsewhere requirement. You can now apply for the Paycheck Protection Program loans through existing SBA lenders, whether that's your local banks, your commercial banks, community banks, credit unions, and insured depositories. How much you qualify for as an employer depends on your average monthly payroll from the previous year. The maximum amount of the loan is $10 million, and you're eligible to apply for 2.5 times your monthly average payroll. Again, based on last year's records of your payroll costs. Each company is eligible for one loan, but if you're an owner of multiple companies and you happen to have 5 companies, each one of your companies is eligible for a loan, so then you could take up to 5 loans. This program is open until June 30th of 2020. We definitely encourage you to, apply as soon as you can, because there is a funding cap and lenders need time to process your loan. And as of yesterday, it was said that the money is nearly depleted. There's a lot of panic about that. However, if you're following the news, there's talk of an additional $250 billion being considered. So stay tuned, because that too is changing very quickly. All right. So who can apply? All small businesses can apply if they're under 500 employees. All nonprofits that are 501c3 and 501c19, veterans organizations, tribal business concern, sole proprietors, self-employed individuals. Again, the 500 employee count is the measuring stick here. So next, what are the eligible expenses that I can use these loans for? And you should use the proceeds from these loans on your payroll costs, including your benefits, compensation, of course, capped at $100,000 a year, and I'll go into that a little bit more. You can use the money to pay for interest on your mortgage obligations that were incurred before February 15th of 2020. You can use the money to pay for your rent under the lease agreement that's been enforced before February 15th of 2020. You can pay utilities for which service began before February 15th of 2020. And of course, you can use it to pay the state and local payroll taxes. All right. We talked a little bit about the PPP, and I want to take a step back and talk about the EIDL loan, which is the Economic Injury Disaster Loan. This has existed prior to COVID-19. It's an emergency loan to alleviate economic injury to small businesses and nonprofits. The economic injury includes any harm to a company or an organization that shuts down, had to lay off workers, or had supply chain interruption, or suffers economic loss due to a drop in value of its endowment. This loan doesn't have a limit on the number of employees in an organization, and it can be up to $2 million payable at a rate of 2.75% interest rate for nonprofits. And the money is used to pay for fixed debts like payroll, accounts payable, and other bills that could have been paid had the disaster not occurred. However, unlike the PPP, there is not a loan forgiveness component to this. Under the CARES Act and in response to the COVID-19 crisis, applicants who apply for the EIDL loan may receive up to $10,000 because the feds know that it takes usually about 30 days to get through the EIDL process. And what's different is it used to be that you can immediately get $10,000 in grant money if you applied for an EIDL loan. The clarification came out 2 weeks ago that it's actually $1,000 per employee up to $10,000 for the company. All right, so let's fast forward and you now have received the money. What do you do with it? Now what? What do you do? At Puzzle HR, we completely recommend that you have really good record keeping. So the forgivable amounts are greater than, so that you can get the maximum of the forgivable amount. The federal government has set aside the expenses that you can use, and I'll go through that in just a second. So it consists of costs related to the continuation of group healthcare benefits during a period of sick paid medical or family leave and insurance premiums and wages and rent and utilities and mortgage interest payment. What is considered what's considered payroll? It is employee salaries, their commissions, or similar compensation. And the compensation is capped at $100,000 per employee per year. There were some questions about if this $100,000 is total compensation with benefits and with other earnings. And the answer is no, it's capped only at $100,000 for wages, does not include benefits. It also, it's also important to keep record of your FICA withholding, and you do that through your payroll processor or your QuickBooks Online or whatever. And you have to keep record of compensation for individuals with primary place of residence outside of the US. You gotta also keep record for your emergency sick pay or your emergency FMLA where credit is allowed. And again, what's different is that independent contractors can apply for the Paychecks Protection Program. However, these individual contractors or 1099 are not to be counted in your payroll costs. That factors into the 2.5 times calculation for how much you're able to apply for a loan. It also covers, you should also keep records of your payment of interest on your mortgage obligations, excluding prepayment or payment on the principal, and records on your rent, your utilities, and interest on any other debt obligation held prior to February 15th. And as of yesterday, there were a lot of questions running around like who would determine forgiveness and when can I apply for it? It's been clarified that the banks and the lenders, the ones who approve your loan, will determine if your expenses meet the criteria set by the CARES Act. So the bank that you went that approved your loan will be the one to determine how much they will forgive. You can apply directly to the lender for forgiveness, and in order for the loan to be forgiven, an officer of the company has to provide certification that at least 75% of your costs were payroll related, and that it went into keeping your head count the same. Remember, the purpose of the CARES Act is to keep American workers going and to keep employers from shutting down doors. So the loan that you're getting needs to go into that effort. And there were also a lot of questions about, well, what if I laid off my employees because I didn't have enough work or I didn't have money? But now that you've gotten the loan and money is in the account, you have up until June 30th to bring those employees back. Now, if you laid off 10 employees, you got to bring back 10. The next question is, do you have to bring back the same 10 employees? And the answer to that is no. You as an employer need to bring back 10 employees. Simple, just like that. Okay, so again, when you do get the money, you've got to account for it. At Puzzle HR, we totally recommend that our clients keep the PPP funds in a separate bank account so that you can track utilization of it without commingling. Because what happens if the expenses that you use the funds for were not eligible, right? There's got to be an accounting of that. And what happens is that any false statement of expenses is punishable by law and can carry up to 5 years of imprisonment and up to $250,000 assessed penalty. Nobody wants that, right? So keep good records of where you're spending that money. The payback rate of the amount that were not used for payroll expenses can be paid back at a 1% interest rate for up to 2 years. When the law first came out, it was payback at the rate of 0.5%, but now it's been confirmed that it's 1% for 2 years. I know I said that, I went through that very fast, but you'll have access to this deck so that you can see the information later. And of course, you can ask questions of us as we go along. I'm going to turn this over now to Michael Burns. And Michael, if you'll introduce yourself and go through your medical slides, I'll go ahead and click it for you. You just let me know when you're ready to move forward. Okay?
All right. Well, thank you very much, Mona. That was very informative. We would definitely appreciate all the great information there. Everyone, my name is Michael Burns. I am the owner of Health Wealth Advocates, an independent insurance agency here in the DC metro area in Reston, Virginia. I'm also the director of insurance and group benefits at Blueprint Financial Group, which Andre is also a part of. So I'm going to go over today how the healthcare benefits are affected by the whole COVID situation. I'll talk about it from an employer perspective, and I'll also talk about it for anyone that might have an individual plan or know someone that has an individual plan, how it would be affected from that perspective as well. So Mona, if you can move forward to the next slide. All right. So there's really 4 areas that we'll be focusing on today. One is the healthcare. Next is HDHP, which stands for High Deductible Health Plan. So there's some specific changes as
Michael,
yes.
Not to interrupt you, we're getting some complaints of echo and feedback. I'm not sure if there's any way you can fix your mic. There are quite a few comments that say you're hard to hear.
There's nothing I can do on my end. I thought that was taking, I had that issue before and I thought I had addressed it. Really sorry. I don't know what I could do to change that. So I'll try to talk as close to the mic as possible. Maybe that would be helpful.
Perfect,
So
thank you.
yeah, hopefully this is a little bit better. My apologies. So anyways, so the breaking it down into 4 parts, we have healthcare, high deductible health plans, special enrollment periods, and ancillary benefits. So if you can go to the next slide, Mona. First, one of the most important things is that one of the mandates of the CARES Act in Section 6001 is that there is no cost sharing for COVID testing or related services. So I want to go into a little bit more depth on that and what that means. So that pertains to all group health plans and all individual health plans from any carrier. It also pertains to self-funded plans. If there's a self-funded plan, it's possible you'll have to change your plan and update your plan document. So if you want to reach out to your broker or your TPA to make sure that your plan is remaining compliant there. And that also applies for HSA compatible plans. And so even though typically that would not be covered at no cost sharing, with an HSA plan, it will be in these circumstances and it will not lose its HSA status. It also applies to telehealth. So one of the first things they say if you have early symptoms is to try to do a telemedicine visit for the testing before you come in. So it's going to be covered in telemedicine, urgent care, emergency room visits. It's also going to cover for serological tests, which test the level of antibodies a person has when responding to an infection, such as COVID. It's also going to cover if you're in for a test. If you're in for a test for COVID and they test for other respiratory illnesses, it will also cover those without any cost sharing. As far as the treatment, so we get a lot of questions about the treatment for COVID. That is a different thing altogether. Some insurance carriers are covering the COVID treatment with no cost. Some are still running through the regular cost of your healthcare plan. So you have to check with your plan and your provider, check with your broker on that. There are also possibilities of surprise, we call it the surprise medical bill, which is balance billing. So if you're going out of network for those type of services for the treatment, they're working on a solution for that. But and part of it is with the $100 billion stimulus the hospitals received. They're told that they cannot do balance billing. So they're still working all these things out. So telemedicine is another big thing. So again, that is used as a preliminary, testing mechanism. But also, since we're all at home and we're not able to get out for our checkups, and if we're not able to get out for our checkups, or we're not able to, we're sick and we're not able to go to the doctor, it's not an emergency, telemedicine is recommended. And a lot of the carriers are covering that at no cost sharing as well. The next thing is payment grace periods. So a lot of companies are having trouble paying their premiums. So most carriers will work with you to give you a delay in payment of your premiums. So that's, again, you want to reach out to your healthcare provider, reach out to your broker to discuss those options as well. I know, carriers like Kaiser, for example, they have, for members that might have healthcare costs due to COVID for the treatment, they will work with them to, they have special payment programs and, payment forgiveness programs that they will help you with. So there's a lot of things out there. With telemedicine, not just for the physical health, the other thing too is mental health. So there's a lot of carriers, Kaiser, for example, Anthem has their Sydney Health app. that they're for mental health. So they're promoting that as well. So Mona, if you can go to the next slide. All right, so the next is high deductible health plans. Previously, telemedicine was not able to be covered before the deductible, but now until December 2021, they will provide pre-deductible no cost sharing telemedicine for an HSA compatible plan, and it will not lose its HSA status. That must be, the plan year must begin prior to that date. And again, that is a sunset provision of December 2021. With HSAs, FSAs, and HRAs, they're going to have, they have now allowed, if you remember in the past when HSAs first came out, they would allow over-the-counter medication to be used as a qualified medical expense. That is back again, and there is no sunset provision on that, so it seems to be a permanent thing. For a further list of that information and what is considered a qualified expense, it's things like Tylenol, Claritin, Pepto-Bismol, menstrual care products. There's a whole laundry list of items that are covered for over-the-counter medication. We can give you an extensive list if you like. We can get that out to you. If you can go on to the next slide. All right, so special enrollment periods. So a lot of the carriers this is already passed for, but typically if you're on a group health plan, you only have one time of the year where you can get in your plan if you had waived coverage previously, and that's your open enrollment period. If you are still not on your company plan and you want to get on your company plan, you have the ability to do so. Right now, the only one I'm familiar with is the DC Health Link. So if you're a small group in DC, for all carriers, they're allowing you to get on as a special enrollment period. There's no end date established for this, and it's effective either April or May 1st. If you're on the SHOP plan and your state has its own exchange, you might want to check with that state. Healthcare.gov is not doing a special enrollment period. For individuals, all states that have their own exchange are doing special enrollment periods. So check with your state exchange. You should be able to secure coverage. States that are on healthcare.gov, they are not doing a special enrollment period, but a lot of people are losing coverage and they would have a qualifying event. And if you lose coverage, you have 60 days anyways to secure coverage. If that does not apply to you and you still need coverage, there might be other options out there like short-term medical plans that may be able to that you may be able to enroll in. So again, you can check with a broker and they should be able to help you with a short-term medical plan. It's not going to be the same as a regular plan, but it would be, it would provide some level of coverage for you. Next slide, Mona. All right, so the last one here, we have a couple things that we want to go over. One is teledentistry. So that's another thing that is prevalent because a lot of people you're not able to get out for your regular dental visits, but it's important to keep up your dental health. So teledentistry is a lot of the dental providers are offering this as a service. So check with, if you have a dental plan, check with your dental plan and see if that is available, and definitely take advantage of that. It's important during these times to still keep up our health and our physical health, our dental health, as well as our mental health, which leads us to the next thing here, which is an EAP program. A lot of, whether it be a healthcare plan or an ancillary provider or a standalone EAP plan, they provide for a lot of resources and therapy for mental health, anxiety, stress, depression, things like that. It's a really tough situation that everyone's going through. So definitely, if you have that available to you, please take advantage of that. As I mentioned before, a lot of the carriers have apps that you can use. Kaiser has the My Strength app. Anthem has the Sydney Health app. But check with your healthcare provider or your company to see if you have an EAP program available to you, and definitely take advantage of that. That's all I had today. So I will pass the mic now to Andre. Hopefully his mic is better than mine. Sorry about that.
Awesome. Thank you, Michael. And thank you, Renee, for inviting us. Mona, Michael, again, thank you for sharing so much great information already. And everyone, thank you for your patience. I know we're going a little over today. There is just so much information, as you can imagine, with the CARES Act and everything we're reviewing today. And we're not even hitting on everything, and there's just so much out there. Michael, I know I always get excited to hear when you mention teledentistry, since it's one way I can get a dentist appointment without them sneaking the drill or a giant Novocaine needle on me. So thank you. Well, as Mona mentioned earlier, we're all in this together, and we want to do our part to help whoever we can weather this storm and come out stronger on the other side. So again, my name is Andre Berady, and I specialize in the 401k and retirement plan business space. I'm teamed up with Michael and Northwestern Mutual, and specifically Blueprint Financial Group. So we are specialized in helping our clients understand exactly where they are and define where they're going and evaluate all the possible paths to get there. So I'm going to spend a little time today and focus on the key retirement plan issues in the CARES Act, and specifically the major provisions affecting your company's retirement plan and what actions need to be done or taken by plan sponsors, and what's available out there for you with the CARES Act and the retirement plan space. Next slide, please, Mona. Thank you. So recognizing that millions of Americans may need to tap into their savings to offset loss of income in the near term, Congress expanded both retirement distribution options and loan options for defined contribution or 401k plans. On the opposite side of the coin, Congress also recognized that required minimum distributions for those over 72 could lock in losses in the current financial markets and defined benefit plans would face during funding issues. To address all these, Congress passed a number of retirement provisions that plan sponsors may elect to take advantage of or not. So retirement plan sponsors have some decisions to make right now. So, one thing I want to stress is that may elect to take. So these provisions that are out there and some of this relief that was put into place, for those of you out there that are business owners or directors of nonprofits and have retirement plans that you offer for your employees, these provisions are out there. It doesn't mean that they're automatically available in your retirement plans. These are things that may or may not be elected, and there's some decisions that have to be made there. So we'll talk about what these provisions are, both as a participant in the plan as well as a plan sponsor or a business owner or director that sponsors a plan. Next slide, please. Let's start by reviewing who qualifies. So the CARES Act provides loan and withdrawal relief to participants who qualify. Individuals will be eligible for the expanded loan options or a coronavirus-related distribution, or a CRD, if they have either been diagnosed with the coronavirus, their spouse or dependent has been diagnosed with coronavirus, they have had adverse financial consequences stemming from the pandemic as a result of being quarantined, furloughed, laid off, having reduced work hours, or being unable to work due to lack of childcare, the closing or reduction of hours of a business owned or operated by the individual, or other factors as determined by the Treasury Department. It's clear for CRDs or coronavirus-related distribution participants that they can self-certify to the plan that they meet these qualifications. So again, if you are a plan sponsor, a business owner, or director, you don't, from a fiduciary standpoint, they don't need to bring you proof that this has happened. They could self-certify that they've had this hardship. So it's a little bit different than a hardship distribution. So they can self-certify. which will simplify the plan administration considerably for you guys. However, the new legislative text does not make it clear that the plan can rely on self-certification for the loan piece. So it's likely that that's the intention. We're awaiting from the Treasury to provide some additional guidance here, but for right now, self-certification is available for the withdrawal portion, but not necessarily on the loans. Now that we know who qualifies, let's review the expanded options for distributions, loans, and RMDs, the required minimum distributions. Next slide, please, Mona. So dig deeper into the CRDs, or coronavirus-related distributions. So the CARES Act provides a new distribution option that is available for participants, including current or in-service employees who are under age 59 and a half. The new coronavirus-related distribution must be made in 2020 and come from either a 401k or a 403b plan or an IRA, and it can be up to the amount of $100,000. This is an amount aggregated across all plans in a control group. So if you have an old 403b and a 401k at your new company, you can't take 100,000 from both if you have two balances that are that high. It's a total in aggregate of $100,000. You will avoid the 10% early withdrawal penalty. So as part of this CARES Act, as long as you meet that criteria that we just went through, you avoid that 10% penalty. There's no required withholding. So typically there's a 20% withholding. So that's 30% right there, the 10% early withdrawal penalty and the 20% withholding that's gone. And alternatively, the tax that's due, so you still have tax, it's still taxed, but that tax can be paid over a 3-year period, or you can choose to pay that withdrawal back as a rollover into the plan within 3 years. So you could either pay the taxes due over 3 years. So for example, if that tax consequence of taking that money out of the plan is $15,000, you could choose to pay $5,000 a year in taxes. So $15,000 that would normally be due for that tax year, you could pay $5,000 a year over 3 years to pay it back, or you could pay the full amount back into your retirement plan over 3 years and not pay taxes at all. So you have a few options with this coronavirus-related distribution. Next, let's talk about the loan option. Next slide, please, Mona. Perfect. So the expanded loan provisions essentially eliminate the 50% collateral requirement, permitting participants to borrow up to $100,000 or the full amount of your balance if it's less than $100,000. So the limit does take into account any existing loans you have. So the way a loan in a 401k works currently is you could take a loan up to 50% of your balance, not to exceed $50,000 for up to 5 years. So for example, if I have a $100,000 balance in my account, I can take a loan up to $50,000 using the traditional rules. I could take a loan up to $50,000 for 5 years. With these new rules, if I have one of those, if I meet one of the conditions above, I can take the full balance, that full $100,000, up to 5 years as well. Further, any loan payments due between March 27th and December 31st of 2020 may be delayed for 1 year, but interest on those loans will still accrue. So the loan will then be re-amortized in 2021 to reflect the accrued interest, but the delay will not result in the loan otherwise being treated as extended beyond that 5 years. So, you know, really what this loan option is doing is it's getting rid of that 50% collateral requirement. It's allowing you to take your full balance that you have in your 401k up to that $100,000 mark. It does take into account any existing loans. So if you already have a loan out for $20,000 you have $100,000 in your 401k, you can only take out an additional 80,000. You still can only take out to that max. You have no payments due through the end of 2020. That interest will still accrue, and you still have that maximum 5 years, and that 5-year count won't start until 1/1/2021. So again, they're just loosening the guidelines to allow you to take the most of your balance. And then if we can go on to the next slide, Mona. Perfect, thank you. And then finally, the RMDs, or the temporary waiver for required minimum distributions. So really this applies to people who are age 72 with the new Secure Act rules, or historically age 70 and a half prior to 2019. Really with the volatility in the marketplace because of COVID-19 and the stressors in the economy, the temporary waiver for required minimum distributions is just saying that they're not going to make people take these required minimum distributions and take money out of the retirement plan while the market has taken a hit and there has been a reduction in their balances. So this is a temporary waiver, and a plan can be retroactively amended to permit this waiver. This would give participants the ability to suspend receipt of these RMDs that would otherwise be required to be made in 2020. And this is included by those who reached not only their required beginning date during 2019, but also if you were a beneficiary of an RMD, and these are life expectancy payments. So if you were a beneficiary from one as well. And then next slide, please, Mona. Thank you. And then I just wanted to circle back on keyword elect. So earlier you heard me mention that the keyword is elect for plan sponsors. Anyone on this call that is a plan sponsor or director of a retirement plan, plan sponsors will have to adopt these new features. So since these loans and withdrawal options are made available through the CARES Act, plan sponsors will have to choose whether or not they want to adopt these and allow participants to have to be available to take action on some of these items. This may sound controversial, but we need to ask if the retirement-related provisions of the CARES Act are a good thing. In a sense, of course they are. They give people more flexibility and a choice, but are they providing a lot of short-term benefit without considering whether in the long term they are the right thing to do? The CARES Act permits plans to increase the maximum loan of $100,000 or up to 100% of the vested amount of somebody's retirement plan. But paying back such a sizable loan will take hundreds of dollars per paycheck, potentially over $20,000 per year from an employee. Plan sponsors may be legitimately concerned whether that is a reasonable thing for most people to do. Finally, people who take a loan or withdrawal risk selling out of their positions in their retirement and buying back at a higher price later if the markets rebound in the meantime. So it's a double-edged sword and something that a lot of plan sponsors may want to consider. So, I say that being that 401k and retirement is where I spent the last 12 years focused on educating plan sponsors and participants and what to do. So these are some great features to have. It is a double-edged sword, and we just want to make sure we're here educating everybody on what's available to them. But I wanted to stop there. I know we're over time, and turn it back over to Renee.
So this is Danae Johnson. Unfortunately, Renee had to step away. Yeah, Danae and Renee. So I am Danae Johnson. I'm the Chief Program Officer at the National Center for Victims of Crime. And we at the National Center would just like to thank you, thank all of the panelists as well as the participants for attending this webinar. If your questions have not been answered, we will be posting those questions on our Facebook page, and we will be sure to email those out email you the Facebook page information as well as the slides that are attached to this particular webinar. We will be hosting another webinar coming up. The next topics will be on domestic violence and child abuse during COVID. And again, we would just like to say thank you. And unfortunately, because we have ran out of time, we will be posting all questions to our Facebook page. If you did not get an opportunity to type in your questions, you're more than welcome to either post them on the Facebook page or email them directly to us.
Danae, did we lose you?
I'm still here.
Okay, sorry.
That's all right. That's all right. Thanks, everybody. We will be emailing the Facebook page information to everybody who attended.
Thank you.
Absolutely.
you.
Thank you.